Tom DeMarco looking for a top. On the other hand, some saying, look, it's not as bad as we think. Where do you still stand?
I think the problem is that earnings are not, so you were growing rapidly through 2018. The last quarter of 2018, things slowed down. We're looking at projections for earnings this year to not really be up until the fourth quarter meaningfully versus last year. So that you've got the second derivative there of change is negative. So that tends to be not a positive thing for the markets. We've snapped back so much since December that if you look at the balance between risk and reward here, I think it's not as easy to say which way it's going to go. I think we are going to get some decent news out of trade eventually. I don't think we're going to escalate. So that's a positive thing. The question is what's left? Because we've got the Fed, we don't have a government shutdown, we get a trade deal. So now you really have to see some earnings growth and some underlying economic strength, I think, for the market to say, okay, it's worth another leg up.
So, Jim, first of all, we have some tough comparables because last year it was going up, 24% or something earnings. Yeah. So you can't keep up that pace forever. But how much of it is underlying economic strength in the growth? And what do we expect this year?
Yeah. Well, there are a number of reasons to expect slowing, of course. Number one, last year was boosted by the tax cut. And I think I've seen even some estimates that the way that works, it could even be a slight negative, not just the loss of that positive, which probably added 10 percentage points to the year-over-year increase in profits last year. On top of that, certainly S&P 500 profits depend on a lot more than the U.S. economy. The global economy is disproportionately important, and more than 40% of sales come from the rest of the world for the S&P 500. So the extent the rest of the world, global growth, if anything, is slowing maybe even more than U.S. growth, then that's a negative. On top of that, the oil sector is disproportionately important for the S&P 500. We saw that when we had our earnings recession back in 2015 or so. So when oil prices go down disproportionately, that is a negative for the S&P 500, even though for the economy as a whole there are pluses and minuses for the consumers. So you put all those things together and U.S. growth is slowing as well, then there are a lot of good reasons to think that profit growth is going to be a lot weaker this year than it was last year. I don't have a specific number. My guess would be if we get even 2% GDP growth, we squeeze out a little bit of profit growth out of this, but it's not a strong profit year by any means.